Hello, welcome to Capital Sensei. Today we're diving deep into the world of angel investing using a fantastic guide, the book Angel by Jason Calacanis. We'll break down what it means to be an angel investor, how you can get started even with a small amount of capital, and explore Calacanis' specific battle-tested strategies for picking potential winners. We'll cover how to find deals, what to look for in a founder, and the tough math behind this high-stakes game. Whenever we can, we try to answer questions in the comments section. This is a complex topic, and everyone's journey is different. So please, as we go through this, if you have questions, personal stories about investing, or even about a startup idea you've had, share them below. Your experience helps everyone else learn, and together, we can build a really knowledgeable community. So, what exactly is an angel investor? Forget the heavenly imagery for a moment. In the world of finance, an angel is simply an individual who provides capital for a business startup, usually in exchange for convertible debt or ownership equity. Think of it as the earliest stage of professional investment. Before the big venture capital firms with their nine-figure funds get involved, there are the angels, writing checks to help a brilliant idea get off the ground. You're essentially the first believer. You're the person giving a couple of smart engineers in a garage enough money to quit their day jobs, build a prototype, and prove their concept. This is a high-risk endeavor. Let's be crystal clear about that. The vast majority of startups fail. They run out of money, the founders have a falling out, or the market simply doesn't want what they're building. The risk is immense. But of course, with that high risk comes the potential for extraordinary reward. If you invest $25,000 in a company that later becomes a household name, that small check could turn into millions or even tens of millions of dollars. You're not just investing, you're buying a lottery ticket with much, much better odds than the Powerball, provided you know what you're doing. Jason Calacanis, the author of Angel, is one of the most successful angel investors in history. He was an early investor in companies like Uber, Robinhood, Calm, and Thumbtack. His check into Uber, for example, turned $250,000 into an estimated $100 million. He didn't get there by luck. He got there through a repeatable process, a specific mindset, and a ton of hard work, which he outlines in his book. One of the first and most crucial concepts Calacanis introduces is the barbell strategy for your personal finances. This is a brilliant way to manage risk, and it's a non-negotiable first step. Imagine your total investment portfolio is a barbell. On one end, you have 90 to 95% of your capital in safe, stable, even boring investments. Think index funds, real estate, bonds. This is the heavy, secure side that ensures your financial future is protected. Then, on the other end of the barbell, you have a very small portion, say 1 to 10% of your net worth, dedicated to high-risk, high-reward angel investments. This separation is vital. You should only be investing money in startups that you are fully 100% prepared to lose. If a deal goes to zero, it shouldn't affect your ability to retire, pay for your kids' college, or sleep at night. This is your venture money, your fun money, your shot at the moon. So how do you actually get started? You don't just wake up one day and start writing checks to strangers with a PowerPoint presentation. Calacanis lays out a clear ladder to climb. The first rung is education and networking. You need to immerse yourself in the world of technology and startups. Read TechCrunch, listen to podcasts like This Week in Startups, which Calacanis hosts. Follow venture capitalists and founders on social media. Your goal is to develop what's called pattern recognition. You start to see what a good idea looks like, what a bad pitch sounds like, and who the key players are in different industries. You also need to start attending industry events and meetups, even virtual ones. The goal isn't to find a deal on day one. It's to learn the language, understand the culture, and start building a network of people who are smarter than you. The next, and perhaps most important, step for a beginner is to join an investment syndicate. Think of a syndicate like a group of friends pooling their money to buy something expensive that none of them could afford on their own, like a vacation home. In the investing world, a syndicate is led by an experienced angel investor who finds and vets a deal. They then offer a piece of that deal to a group of smaller backing investors. Platforms like AngelList have made this incredibly accessible. A lead investor might secure a $200,000 allocation in a hot new startup. They might invest $50,000 of their own money and then offer the remaining $150,000 to their syndicate members in small chunks, sometimes as little as $1,000 or $2,500. This is a game changer. For a very small amount of money, you get to invest alongside a pro. You get to see their deal memo, which explains why they believe in the company. You learn from their due diligence, and you get access to deals that would be completely invisible to you as an individual. Calacanis himself runs a very popular syndicate, and he argues this is the absolute best way to learn the ropes. You're an apprentice to a master craftsman. After you've made 10 or 20 of these small syndicate investments, you'll have a much better feel for the process. At this point, you might be ready to start writing your own small direct checks. We're talking $5,000, $10,000, maybe $25,000 at most. This is when your personal network becomes critical. The best deals often come from warm introductions. A founder you know introduces you to another founder, or a fellow angel from your syndicate flags a company for you. Now let's get into the core of the Calacanis method: how to evaluate a startup. He famously says you should bet on the jockey, not the horse. What he means is that the founder is more important than the idea itself. A great founder can pivot a mediocre idea into a great one, while a weak founder can run a brilliant idea straight into the ground. So, what does he look for in a founder? The first trait is resilience. He wants to know if the founder can take a punch, get knocked down, and get right back up. The startup journey is brutal. It's a relentless series of rejections, setbacks, and crises. A founder who is easily discouraged or gives up when things get tough is doomed to fail. He often asks founders about the hardest moments in their lives to gauge their grit. The second trait, and this one sounds a bit controversial, is what he calls being deceitful. Now, he doesn't mean they should be liars or cheats. He's talking about what Steve Jobs famously had: a reality distortion field. This is the ability to paint a vivid, compelling picture of a future that doesn't exist yet, and to do it with such conviction that they convince employees, customers, and investors to believe in it too. They have to sell the dream. Another key trait is being exceptionally stingy. He wants to see founders who are frugal to the point of obsession with the company's money. Are they flying coach? Are they buying used desks? A founder who treats investor capital like their own hard-earned cash is a founder who will make every dollar count, extending their runway and increasing their chances of survival. A founder who is quick to spend on lavish offices and perks is a massive red flag. Finally, he looks for obsession. The best founders are completely, utterly obsessed with the problem they are solving. They live it, they breathe it, and they can't imagine doing anything else. This isn't just a job for them, it's a mission. This obsession is the fuel that will carry them through the inevitable 12 to 16-hour workdays and the years of struggle required to build something meaningful. Once you have a great founder, you can start looking at the horse, the business itself. The first question is about the market. Is the total addressable market, or TAM, big enough? In simple terms, the TAM is the total amount of money that could possibly be spent on this type of product or service in a year. Imagine you're selling a new kind of fishing lure. Your TAM isn't just people who fish, it's the total annual spending on all fishing lures. Calacanis wants to see a TAM of at least $1 billion. Why? Because angel investing follows a brutal power law curve, which we'll discuss more later. You need your winners to be massive, billion-dollar-plus outcomes to pay for all your losers. Investing in a small market, even with the best founder and product, is like being the world's best fisherman in a tiny pond. You'll never catch a whale. Next is the product. Is it 10 times better than the existing solution? A slightly better product rarely wins. It needs to be a leap forward. It needs to have what investors call traction. Traction is evidence that people actually want what you're building. This can be user growth, revenue, high engagement rates, or glowing testimonials. An idea on a napkin is worth almost nothing. A product with a small but fanatical group of early users is worth a great deal. Then you have to look at the deal itself. This can feel intimidating as it's full of strange jargon. The two most important terms to understand on an early stage deal are the valuation cap and the discount. Most early investments are made using a legal instrument called a SAFE, which stands for Simple Agreement for Future Equity. You're not buying shares today. You're buying the right to shares in the future. The valuation cap is your best friend as an early investor. It sets a maximum valuation at which your investment will convert into equity. Let's say you invest $100,000 on a SAFE with a $5 million valuation cap. A year later, a big venture capital firm invests at a $10 million valuation. Because of your cap, your money converts as if the company was only worth $5 million. You get twice as many shares for your money as the big VC firm. It's your reward for taking the risk a year earlier. The discount works similarly. A SAFE might have a 20% discount. This means that when the priced round happens, your money converts at a 20% discount to the share price paid by the new investors. Sometimes a SAFE will have both a cap and a discount, and you get whichever one gives you a better deal. Understanding these terms is crucial to ensuring you're being compensated fairly for the early stage risk you're taking. Now, let's talk about the holy grail of angel investing, deal flow. Deal flow is simply the number and quality of investment opportunities that come across your desk. Having great deal flow is everything. You could be the best poker player in the world, but if you're only ever dealt bad hands, you're going to lose. Your job as an angel is to get yourself into the games where the best hands are being dealt. How do you do that? You have to build a brand. You need to become known as someone who is smart, helpful, and adds value beyond just a check. As Calacanis preaches, you need to be helpful. This could mean blogging about your industry, hosting a podcast, or being super active and insightful on social media. It means offering to make introductions for founders, even ones you don't invest in. Founders talk to each other. If you get a reputation for being a great partner, the best founders will start seeking you out. They don't just want dumb money. They want an investor who can open doors, provide strategic advice, and be a cheerleader for them when times get tough. Your reputation is your most valuable asset in generating high-quality deal flow. This is why starting with syndicates is so powerful. It immediately gives you access to the deal flow of a seasoned professional. You're seeing what they see. As you build your own network and reputation over time, you'll start to generate your own proprietary deal flow, which are the opportunities that nobody else is seeing yet. That's where the real alpha, or outsized returns, can be found. Let's circle back to the math of angel investing, because this is where the economist in me gets both excited and very, very cautious. Angel investing does not follow a normal distribution of returns like the public stock market. It follows a power law. This is a tough concept, so let's break it down with an analogy. Imagine you're a baseball scout. If you sign 100 players, you don't expect 51 of them to be slightly above average and 49 to be slightly below. That's not how it works. You expect maybe 80 of them to never make it out of the minor leagues. Maybe 15 will make it to the major leagues and have decent careers. 4 might become all-stars, And if you're incredibly lucky, one becomes Babe Ruth, a player so legendary that his success pays for the salaries and signing bonuses of every other player you ever scouted, 10 times over. That's the power law. In a portfolio of 50 startups, you should expect 30 or 40 of them to fail completely, returning zero. You might have 10 to 15 that return your money or maybe double it. And you're hoping for 1 or 2 that return 100 times, 500 times, or even 1,000 times your initial investment. That one home run, that one Uber or Google, is what makes the entire strategy work. This has a critical implication. You must diversify. Making 1 or 2 angel investments is not investing, it's gambling. It's buying a lottery ticket. To have any statistical chance of hitting a power law winner, you need to build a portfolio. Calacanis recommends making at least 50 investments over a 5 to 10-year period. This smooths out the risk and gives the law of large numbers a chance to work in your favor. Another crucial part of the math is the concept of follow-on investment. When one of your portfolio companies is doing exceptionally well and goes out to raise another round of funding, you will typically have pro rata rights. This gives you the right to invest more money in the new round to maintain your percentage ownership. Calacanis argues you should not only exercise these rights, but actively try to invest even more. This is called doubling down on your winners. Think about it. At the seed stage, you invested based on a dream and a great founder. Now, 2 years later, the company has a real product, real revenue, and a team that has proven it can execute. The investment is significantly de-risked. This is where the truly massive returns are generated. Your initial $25,000 check might be the seed, but your follow-on checks of $50,000 or $100,000 are what grow the giant tree. Before you get too excited and start looking for your checkbook, we need to address a legal and practical hurdle: the accredited investor rules. In the United States and many other countries, to invest in private companies, you generally need to be an accredited investor. This is a rule designed to protect individuals from losing their shirts in high-risk ventures. Historically, this meant you needed to have an annual income of over $200,000, or $300,000 for a couple for the last 2 years, or have a net worth of over $1 million, not including your primary residence. This, quite frankly, excluded most people from this asset class. However, the rules are changing. The rise of equity crowdfunding platforms, thanks to legislation like the Jobs Act in the US, has opened up avenues for non-accredited investors to put small amounts of money into startups. The rules are different and the platforms are highly regulated, but it is a pathway. Calacanis' book is primarily aimed at those who can become accredited, but the principles of evaluation and portfolio construction are universal. You also need to be brutally honest with yourself about the time commitment. This is not passive investing like buying an S&P 500 index fund. Successful angel investing requires work. It requires hours of reading, learning, networking, and due diligence. You have to review pitches, talk to founders, and maybe even help your portfolio companies. It's a serious hobby at minimum and a part-time job for many. And finally, there's the psychological toll. You need the stomach to watch most of your investments go to zero. You will see founders you believed in fail. You will write checks that you never see again. And you have to be okay with that, knowing it's part of the process. Furthermore, this is a long-term game. You won't see any returns for at least 5 to 7 years, and a big exit might take 10 or 12 years. This requires incredible patience. So, to recap the core journey Calacanis lays out, first, secure your financial foundation with the Barbell strategy. Only play with money you can afford to vaporize. Second, immerse yourself in the startup world to learn the patterns. Third, Start by investing small amounts through syndicates to learn from the pros. Fourth, focus obsessively on the quality of the founder. Look for resilience, a reality distortion field, frugality, and obsession. Fifth, ensure the market is massive and the product has traction. Sixth, understand the deal terms, especially the valuation cap, to protect your upside. Seventh, work tirelessly to build a brand and network that generates high-quality deal flow. And finally, build a diversified portfolio of at least 50 companies and be prepared to double down on your winners, because that's where the Babe Ruths are found. Angel investing is not for everyone. It is a demanding, risky, and often humbling pursuit. But as Calacanis shows, it can also be intellectually stimulating, personally rewarding, and financially life-changing. It's an opportunity to get off the sidelines and actively participate in building the future, one small check at a time. It's about funding the dreamers, the builders, and the crazy ones who are just stubborn enough to think they can change the world. And sometimes they actually do.